Well, good afternoon. Time to check in on those markets and lots to discuss, especially those FOMC minutes where Fed officials recognizing that they may have to take a more restrictive stance when it comes to policy in terms of dealing with inflation. Also concerns coming forward that they are rather worried that inflation expectations could become unanchored. Of course, European markets pushing a little bit higher. Everybody watching what is happening in the UK with regards to the British pound at this point, reacting to the possibility of Prime Minister Boris Johnson resigning. But to talk to us about some of the market dynamics and also talk to us about the performance of the pound, we are joined by Han Tan, who is from Xfinity. And thank you so much for your time. Let's get right into it. Let's talk about the British pound and the market reaction, seeing that we've all focused our news on what's happening in the UK right now.
Indeed. So there's really little relief for the pound here. Granted, there is some price action surrounding the soon-to-be news that we could hear. But keep in mind that this rumor has been playing out in the markets for a while now, adding to the downward pressure on the pound, right? So it's not just the economic woes, but also this political uncertainty adding to the downward pressure on sterling. Now, granted, over on the equity side, you are seeing some gains, and that could be due to expectations for more rate cuts, corporate tax cuts rather, for the corporate sector. But I think overall, it only compounds the economic woes for the UK.
There have been some saying that the next Prime Minister will be fundamental in determining what happens with inflation. Do you go with that view as well?
Not quite, because looking at the policy tools that are available, it seems to be limited on the fiscal side, right? Keeping in mind that the UK economy is already not just facing what could be double-digit inflation by the final quarter of this year. So any more efforts to spur domestic demand and domestic spending would only fan those inflationary flames. And also noting that the UK is running a large current account deficit, that really flies in the face of what the UK government on the fiscal side can really do.
The other question everyone is asking is euro-dollar parity. Is this something we could see anytime soon?
The short answer is yes. Looking at some of the models that we use, there's a greater than even chance that we could see euro-dollar parity by this quarter, and those odds only grow larger as 2022 plays out. Right. So again, I think going back to the fundamental perspective, if you look at some of the economic concerns for the Eurozone and what the ECB could do relative to the Fed, I think that widening policy gap and also the widening yields gap only points to parity for euro-dollar. Is just a matter of time.
What do you make of the FOMC minutes that we got? Because right after that, we saw, a slide in treasuries led by the 2 years. What do you make of some of these statements brought forward there?
I think overall it doesn't really tell us anything new. Now, granted, the yields on the 2 versus the 10 are still inverted, at least last I checked. But I think overall it just underscores the insistence by Fed officials to make sure that their credibility remains intact when it comes to curbing these inflationary
right. And we've touched on the pound. We've touched on aspects of what the resignation will mean for inflation. But let's look at the other parts of the market that everyone has been talking about, and that is the oil price. We've had two of the biggest asset managers, Goldman Sachs and Citi, taking different views when it comes to what they expect in terms of the oil price. Goldman a little bit more bullish than Citi, that is seeing a $70 barrel. What's your assessment on terms of those two views, and which is closer, $150 or $50 possibly?
Oh, wow. I would have to say that it's still a very supportive environment for oil prices, at least based on what I'm seeing. So, from a technical perspective, you do see strong support at $100 a barrel for Brent. Granted, that is being tested now as we speak, admittedly, but that is still a view I cling on to. But also looking at the fundamental structures in the markets, there's still backwardation. There is still ample signs of resilient global demand, in light of the supply constraints. Now, of course, if the recession calculus becomes clearer as we go into 2023, that could alter that equation. But as things stand, I still think that Brent should remain supported above 100.
There are those saying, I mean, if you look at the market and the screens, that the first half of the year is a first half that everybody wants to forget. So going into the second half, what are some of the risks and challenges that you're seeing, and is there a light at the end of the tunnel?
To answer the later part of your question, yes, there's ultimately bound to be that light at the end of the tunnel. It just depends on how protracted that expected recession is, right? And therein lies the key theme for the second half of this year. It's one of the recession risks and also the inflation risks, and perhaps more importantly, how central banks navigate between those two forces, right? Can they actually engineer a soft landing? Markets are still highly skeptical about such odds, and that's what we're seeing being priced into the markets.
All right, Han, let's leave there. Thank you so much for your time. And in other breaking news, we did get news out of Mediclinic with the board saying that they are backing the fourth offer coming in from Remgro and MSC in terms of a takeover. So we'll unpack that for you in greater detail tomorrow. That is it from me. We're going to take a quick break. When we come back, we'll have more news for you, so stay tuned.